Hi, this is Nick here, and I'm about to go through the updated chart book for the U.S. equity market. So, starting here on the first slide, no update on the Z1 indicator. We will get the Q2 data later in the month of September. That's going to come out, I think, next week or the week after. So we'll see an update of this gray dotted line here. And we know from the real-time proxy that we track internally that that's going to this line will continue lower. In other words, the equity allocation proxy will be higher, currently at 42.8%, which is historically at a pretty high level, and historically suggests relatively low returns can be expected over the next 10 years. And so that's the same picture there, and we'll have an update on that next month. Then turning to the business cycle backdrop, so the leading economic indicators index is continuing to make new cycle highs. You can see here the high 110.7, that's where we are right now. And on the business cycle chart book, you can see the year-over-year rate of change of this index, and that looks like it might be leveling off or starting to trend down. That's the rate of change of this gray line, but the gray line itself, this index itself, is continuing to make new highs, which is historically a positive sign for stocks. The stock market is also essentially going on to make new highs. Then the earnings backdrop. So Q2 is a very strong earnings quarter for the U.S. The gray line here represents the trailing 12 months earning per share for the S&P 500. The analyst growth projections, according to FactSet, for Q3 and Q4 are 19.9% and 17.5%, respectively. That's a slightly lower growth pace than estimated in last month's report. So we're seeing some downward revisions in the estimated earnings for this quarter, Q3, and for Q4. Then, in terms of the global growth backdrop, so the U.S. manufacturing PMI in red here, that's actually making a new cycle high at 61.3. The other major economies in the world have been more kind of neutral to downward trending in terms of their manufacturing PMIs. So we do see in the data some separation where the U.S. is looking relatively better than the rest of the world, and indeed that's reflected in the U.S. stock market outperformance compared to the rest of the world. Germany's manufacturing PMI ticked down. The other three ticked higher here, but relatively flattish in terms of the Japanese and Chinese manufacturing PMIs, but all of them still above 50, which is important for looking at this picture. Then U.S. financial conditions generally continue to ease, so easing on this index since last month's report, and that is generally supportive for the stock market. Then in terms of market breadth, so we've got some new data here for the first time in a while, because this only takes readings when the S&P 500 is making new bull market highs, and there was a gap here because the last all-time high had been January 26th, 2018, and then we just started to make new highs in the last couple weeks, starting on the 24th of August, and then made basically 3 or 4 consecutive highs through the following week. I think August 29th was the last new all-time high that we had in the S&P, and the reading there on the breadth was 72. So that's above the critical level that I've set here of 65. However, you can see that there is this general downward trend, which is what you would expect in terms of an aging bull market. That's consistent with the idea here in terms of looking at breadth, that it's going to narrow as the bull market ages, and so we do generally see that pattern, and that you can observe that in the previous 2 bull markets as well. So it's still a positive characterization here, but we are seeing lower breadth readings, and it is very common after a break in new all-time highs. If you look at this break that we had of about 1 year between the middle of 2015 and the middle of 2016, you could see breadth came out fairly weakly and then progressively moved higher as the new highs continued. And so I would expect, if we were going to continue to make new highs, which I do think we will, that we would continue to see this breadth trend a little bit higher. But overall, we do observe this downward trend, and that's consistent with the framework for looking at market breadth. One thing to note, and I mentioned it in my closing comments, the S&P 500 cumulative advanced decline line is another a very good way of looking at breadth, and that continues to make intermittent new highs, and indeed made a new all-time high last week, and that continues to look supportive of this ongoing bull market. Then market sentiment here represented survey of bulls versus bears, so we're right around 50% and pretty close to the long-term average. So my view here is that this is neutral. This chart, I think, ought to be viewed from a contrarian standpoint, especially late in the cycle market. I would be concerned to see sentiment at very high levels. I mean, you can see here elevated sentiment right before the the drawdown period that we had at the beginning of the year. But right here, it's at neutral levels, so not a particularly concerning neutral to, I'd say a neutral outlook on this picture. Then margin debt, neutral to positive picture here, because we're not seeing the buildup of margin debt relative to the market, and that has been characteristic of maybe a euphoric or blow off top phase in the bull market in the last two bull markets. Then looking at correlation and volatility, so we actually see correlation represented by the black line here continuing to trend lower again, not making new cycle lows, but heading back down. Maybe short term going to be a positive actually for the equity market, and then the realized trailing 1 year volatility looks like it's starting to flatten out, maybe head back lower here. So those could be near term positives, but I really look at this chart from a medium to longer term framework, and given that we're at relatively low levels on both correlation and volatility, that makes me cautious on the outlook over the medium to longer term. Then uncertainty has decreased somewhat since last month's report. Looks like there might be a little bit of wall of worry left to climb here. These fears, these headlines regarding trade wars or emerging markets or whatever it might be, actually, contrary to, I think, the conventional wisdom on that, is fuel for the bull market to continue. It needs to have a wall of worry to climb. It needs to have uncertainty to continue. Then the VIX curve is positively sloped, so that's generally a positive sign in terms of a trend-following indicator. Suggests path of least resistance is likely higher, in my interpretation. Then the S&P 500 technical picture, so we've got the 200-day moving average in black, the 50-day moving average in gray. I've drawn a line here for the where the all-time high was at the end of January. So we broke through that at the end of August, trended higher, followed through higher in the subsequent week, and then it's kind of checked back and sort of retested, if you will, that new high seems to have held there and currently trading above that level. For the year, as of the end of last week, which was September 14th, we are up about 9% year to date. Coming into this year, the sell side forecasts were for the forecast range was from 0 to 10% in terms of returns. And just to note that returns have actually historically only fallen within that 0 to 10% range 17% of the time, which I think is maybe surprisingly low to hear. 51% of the years have had returns above 10%, and 32% of the years have had negative returns. I've got my checklist here, so really not much change in terms of the interpretation. The overall characterization is that I'm positive over the short term, medium to longer term neutral to negative. And then you can read the concluding thoughts there on the PDF.